Good afternoon. It's Wednesday, the 7th of November, 2007. This is Brian Shannon speaking. The S&P 500 did close down 2.8% with its loss of $4.28 today. And this is the reason why I always stress that defense wins this game. And you've got to listen to the message of the market. The message of the market has been mixed here for the last several months, really. But more recently, with this declining 10 and 20-day moving average, and the fact that so many stocks have been getting just decimated without any bounce in there, it's been showing that the underpinnings of this market have been weakening. And today, we saw pretty much a little bit of capitulation. I don't think that this selling is probably done, but it's definitely causing a lot of damage and anxiety right now. This level that it's at right now, 148, has been an important level. First is resistance on this inverted head and shoulders pattern we had observed back in mid-August, and then once it broke past that, it was tested a couple weeks ago. Very nice bounce, a little more than two-thirds of retracement from that level, and now that bounce has looked like it's completely failed, and we do have a lower high and a lower low. So we could still get a couple more days of selling. Yet we've seen that the bounce that occurred the last couple days has occurred on lessening volume. That's typically a sign that the buyers are losing their resolve. And again, as I've been saying about this 148 level, the more times that support is tested, the more likely it is to fail, as buyers who congregate in that area start to realize that there's just this overwhelming force of supply. They step to the sidelines, and then prices give way. Looking at a 30-minute time frame, this is looking pretty darn ugly to me. You can see an inverted head and shoulders pattern. Yesterday I said that the declining 5-day moving average, these rallies will typically fail, and I was expecting that we needed to see a test of this prior resistance to hold before we had any chance of real upside, but that the fact that we were seeing lower highs and potentially lower lows, which we did get today, made it really tough to be very bullish on this market. This pattern right now suggests that we could still have another 6 points to the downside. That could bring this market down conservatively, if we take it off of the 149 level, down to about 143 or so. That's definitely a possibility. It's happened before, in the recent history of this market, so there's no reason to think it can't. This market, again, has been sending us a lot of warning signs. The semiconductors first broke down several weeks ago, and it was an important warning sign as it broke below that 475. The S&P has been much weaker than the NASDAQ 100, as that market has been held up seemingly by just a few stocks: Apple, Google, Baidu, Research in Motion, etc. But this was sending us an important warning sign. And also that, all those little Chinese stocks that were going so strongly, and so many of them that failed. Now, we were looking at this 450 level. I thought this might be a potential level of support, but I also did warn that just because it's been support in the past doesn't mean it's a good place to buy, because the trend is still lower, and it's just a temporary stopping place. We only know what true support is after the fact, once the market has bounced and driven away from there. We had a little bit of a bounce. It held a support very short term. That rally failed as expected. I wasn't expecting the semiconductors to break down again, but it shouldn't be a surprise because the path of least resistance on the intermediate term time frame here and the daily time frame are all bearish, with the 10, 20, 50, 100, 200-day moving averages all in downtrends. This is a bear market in the semiconductors. The S&P, like I said, has been holding up a lot better. And the reason that I've been most concerned about this, and I've stressed this over and over for the last several months, is the IWM. The Russell 2000 did break below that 78 level. 78.40 actually is the level that we've been looking at in here. And it broke down below there. Yesterday I said that there's still a lot of risk in this market, and that as powerful as this little rally was, we're getting these failed moves, and from failed moves come fast moves. As it traps in these buyers, it robs the market of buying power, basically, is what happens, because shorts get squeezed here, excited sidelines money runs in and buys, and then once they realize it fails, the shorts pile back in and people start throwing their stocks away. It's going to be interesting to see if this 78.40 level will now act as resistance. That's what you would expect to happen. That support once broken tends to act as resistance. And I think we're going to start to see these longer-term levels come into play on the weekly time frame. Looking at a $75 market here in the Russell 2000 wouldn't come as a surprise at all, and it could happen quick. That would take us down to approximately here. It's not my call, it's just an observation. The path of least resistance is clearly lower. This level right here is the first level of that the bears will defend basically at about $78.40. If the market gets back up above that level, it doesn't mean go in and buy. It means that let's wait for some more confirmation from larger time frames that this picture is becoming more bullish. But right now, there's nothing bullish on this daily time frame. The weekly time frame is really giving reason for a lot more concern on the bigger picture as well. And the seemingly bulletproof NASDAQ 100 did finally break. Finally, not that I was waiting for it, but it has. It's still doing what a market does. It rallies, pulls back to the rising 10-day moving average, then the 20-day moving average gets tested, then those fail, and now it looks like this market is likely to head for the 50-day moving average. The 50-day moving average is also the lows that we saw back in late October, and this 50-day moving average is rising. We may see a pullback down to that level. Looking at a shorter-term time frame, let's take a look at the 30. You can see here, same thing. We've got these failed moves, like we saw from yesterday's move. These failed moves create false panic. These failed breakouts create fast, panicky sell-offs, and that's what we're experiencing in here. There's still the potential for support down near that 52 level. It's really not that far away if you look at it in terms of percentage, but it can do a lot further damage, obviously, to people's accounts if this market drops another 2.5–3%. But it wouldn't be really unexpected for it to drop down to that level, or maybe this 50-day moving average rises up to meet it here over the next couple days. But a lot of emotion in this market, a lot of fear, and it's best left for the most experienced and disciplined traders, because that emotion can create some real opportunity if you are alert and if you're fast and if you're disciplined.